Good evening, everyone who's out there listening or watching. I'm Dave DeWitt with DeWitt Capital Management. We're presenting a study tonight on boosting retirement savings and minimizing taxes now. We have with us Scott Frank, who's a certified alternative investment analyst and a certified private wealth advisor. David Jr., who is past the CFA 1, major accomplishment, and studying with the College for Financial Planning for a CFP. And I'm a CFP and a chartered SRI counselor, which is the ESG designation for people that study sustainable investing. So tonight we're going to give out in half an hour a few ideas I think will help people getting ready for retirement. And at this point, David, I think I'll hand this over to you to get us started.
Yeah, sure. Hey, everybody. It's great to be here. So getting right into this, we're going to first set the scene. So what we do know today is that retirement is lasting longer as people live longer. Expenses are only increasing, especially medical expenses, and savings are by and large on average having a hard time keeping up. So some stats for you. For people that are aged 55 to 64, the average 401k account balance in 2020 was $197,322. The average monthly Social Security payment was about $1,500. And there's about, for a 90% chance of having enough savings to cover medical expenses in retirement, a couple would need to have $270,000 saved. So with these facts in mind, there are some challenges that some folks are facing as they prepare for the next stage in their life. So moving on to the next slide. What is enough for retirement? So it varies based on a lot of different factors, but a pretty good study that came out from Morningstar recently showed that using average annual returns of 6%, pegging inflation at 2.5%, they calculate that you would need about 1.18 million in savings to achieve $40,000 per year in annual income.
Yeah, for the next 30 years, right?
Yep.
And I think a couple important considerations here are that taxes, inflation, those rates can vary over a lifetime. So any actual savings rates, investment growth rates, I think should be periodically monitored, certainly leading up to retirement and through to make sure that you're staying on course.
Yeah, for sure. So where does this leave us? So if you're in a situation where you realize that you need to catch up a little bit, that's what we're going to cover today. So there are some tactics. So we're going to cover the IRS's Catchup Plan, the importance and impact of using these strategies. We're going to cover health savings accounts and their tax benefits. We're going to cover a really important asset allocation implication. We're going to show you how you can start to evaluate your situation and show you how you can start to map out your plan. So moving on, the IRS Catchup Plan for investors who are 50 and up. So typically the rule of thumb is if you have a 401k, you always want to fully max out the employer match. So that's obviously a good rule of thumb. And another typical rule of thumb, they would say, is 15% of salary is good to contribute in the earlier stages in your life. But when you're over 50, a really, really powerful way to catch up is to to contribute the maximum and also fully maximize the catch-up provision. And what that means is you would be fully contributing the $19,500 that's allowed, plus the $6,500 extra that's allowed by the end of the year. Actually, correct me if I'm wrong. Is that by the tax filing, or for 401k that'd be by the end of the year? Yeah.
That's right.
So the $6,500 extra.
So that would give you a total of, looks like $26,000.
Yeah, $26,000 extra per year over the age of 50. So, and this matters a whole lot. So assuming do 15 years until you're in planning to retire and a 6% average annual return with the standard 401k contribution limits of $19,500. So this would be, say, 15 years, you're contributing just the $19,500. The account would grow to $481,000. But if you take advantage of the catch-up provision and contribute the full 6,500 extra over those 15 years, you would have an additional $160,000 invested at retirement.
Yes. So the difference between the two represents about 33% more in savings to draw from into the future. So if you just kind of simplistically look at that, if you wanted to say withdraw 4% of that amount of capital, so 4% of the 481,000 is about 19,000 a year. If you were to take 4% of the 641,000, that's about a little over 25,000 a year. So it's a difference about 6,000 or $500 a month. So you can see how some extra savings can help boost the amounts available towards retirement.
Yep. So, and of course, contributing extra to your retirement savings is going to help reduce your tax liability in the near term. So contributions dollar for dollar lower your taxable income, and they won't have the same impact on your paycheck because they come out because the money you contribute comes out before it is taxed. So depending on your tax bracket, $100 contribution may only lower your paycheck by $60 to $80.
Another way to look at it is say it's a married couple earning about $150,000 a year. They contribute $26,000 into a 401k. Obviously, these contributions are made pre-tax, which reduces their effective tax rate, and it comes out to be about a savings of $5,700 or so per year you save on tax because you've lowered it as you contributed pre-tax. Now, the disclosure here that's important is that doesn't assume state local taxes and deductions, how you take deductions. So it's a case-by-case basis, but that kind of gives you a general, kind of how the math works.
And what it really boils down to is, since this is a pre-tax contribution, the amount that you contribute, your actual take-home pay won't be reduced by that amount. It'll be reduced by significantly less than that because of the tax effect not going into effect.
Sure.
Yep. So yeah, definitely utilizing the 401k catch-up plan is a powerful strategy to be considering. Now, another, you don't hear about this as much, but another potentially powerful tool at your disposal could be the health savings account. And there is a triple tax benefit to this. But the whole purpose of the health savings account is if you have a high deductible health plan, you're eligible for this. And it basically allows you to start saving for future medical expenses in retirement. So the tax benefits of the HSA is that it's funded with pre-tax dollars. So you have that same benefit we just talked about. The investments grow tax deferred because it's not taxed as transactions are made. And if you use it for qualified medical expenses, which is pretty broad, withdrawals are not taxed. So similar to the 401k situation, there's a catch-up provision. So if you're 55 or over, you can contribute an additional $1,000 to either the individual or family maximum. And for the individual, the maximum contribution per year is $3,600, and for family, it's $7,200. And that $7,200 can be basically in any combination between spouses, or it can even be contributed by third party, like a relative.
Yeah, the other benefit here is after the age of 65, you can take non-qualified withdrawals, meaning distributions not used for medical expenses and don't have the penalty. Now, you do have to pay ordinary income tax on those distributions, but it effectively just means it's treated very similarly like a traditional IRA when you take money out. The other benefit to it is that there are no RMD requirements for health savings accounts. So you're never going to be required to take money out after a certain age, like say 72.
So just to make sure that we're very clear and everybody understands what it is we're saying, is that the amount that you can contribute to an HSA, health savings account, is $3,600, but there's a catch-up provision. Davian, when does that start?
Age 55 or older.
So then what would be the total after that, after 55, that someone could contribute?
So after the age of 55, you'd be able to contribute $4,600 per year for individual, or $8,200 for family.
Okay. So that's significant. That could be very significant. And ideally, if you can take pre-tax money and save it and compound on a tax sheltered way, and then take the money and not pay tax for your health expenses, that's a real bonus. So, and if you don't use it for health expenses, you can take that money out, pay taxes on it, but it is like an additional savings account, just like an IRA.
That's right.
Right. It's another tool to save to boost your retirement savings, which is, of course, the topic of this discussion. And one final note on that is you could also make after-tax contributions, and then you could deduct those contributions from your gross income for your tax return to reduce your tax bill for any given year as well. All right.
Feels like an IRA. Yeah.
Like an IRA. Yeah. So let's
So really where we are here is you could, for 3 ways, contribute to your IRA, which you can do, contribute to your 401k, and contribute to an HSA, and you can make some real headway here getting ready for retirement.
Yes. Now, another thing to talk about, which you don't necessarily hear that often, is the idea of treating Social Security and or pension income as a fixed income asset. So essentially, and especially in light of Social Security, people don't really think of these as assets in the sense that you can sell your Social Security. But the closest asset that Social Security resembles is like a treasury bond, except with a higher yield. And because the income is essentially guaranteed. Of course, there is always like that talk of the Social Security staying, but for people that are closer to retirement, it's not nearly as much of a worry. So it's basically like a fixed income bond with a better yield, with the benefit that it actually gets stepped up in with inflation, with cost of living adjustments. So with that said, if you were to just treat your Social Security as fixed income, you can potentially it potentially distorts your asset allocation, which we'll get into in a minute, but it may allow investors and individuals to actually increase the amount that their allocation to equities, which has a higher growth rate over time. So what does this all mean? So that may have been a little confusing. So the first step would be to determine the present value of your future Social Security payment. So let's just do a simple example. John Doe, who's age 70, and the assumptions for this example is that his investable assets are 1 million, and he is going to be receiving the maximum Social Security benefit, which is about $3,100 per month. According to the IRS, his life expectancy once he reaches age 70 is 17 years, and the inflation rate we're going to use is 2%, which is the average consumer price index increase over the last 20 years. So the value of his Social Security payments in this example is about $530,000.
So this would be, what this would represent would be if you had $533,000 and you were to let that run for 17 years, that would be worth $533,000. So you're paying it down to zero. And that would be a great asset as a fixed income asset. And as an example, when my dad retired, he had a pension of $40,000 a year that would last for his lifetime and my mom's lifetime. And when you think about what is the value of that fixed payment, it's a lot of money. And so people can think about their Social Security payment as if it was a bond or a self-amortizing bond, so that it's should be factored in to your overall asset allocation. And Davey, I know you're going to get into that.
Yeah, it really is one of the most valuable and reliable sources of income for people who are retired. So to treat it as a separate, as not a part of your assets, can distort your asset allocation, which we'll show you right here in a second. So assuming that John Doe's total investment portfolio is 1 million, and he's decided, or him and his advisor have decided that what makes the most sense for him and his risk tolerance is a 40-60 asset allocation, 40% stocks and 60% bonds. So that's what it looks like. So it's 60-40. But if you include the $530,000 valuation of his Social Security and you add that to his fixed income, you can see he's actually situated 74% fixed income and 26% equity, which is very conservative. And with fixed income returns these days, with interest rates so low, if he has 15 years left until he retires, he's not going to be getting the excess return that you get from having the proper amount of equity exposure. So this is something that a lot of people don't think about. Of course, it does require you to accept that Social Security is an asset in that sense. So if you do up your equity allocation in the years leading into your retirement, there could be some additional volatility, which you have to be okay with. But if you need to catch up a little bit, and you still have some time left before you're retiring, this could be a very powerful way to just adjust your allocation a little bit. All right, so that's that. Now, when it comes to evaluating your situation, you have some of these strategies and you need to come up with a plan. So some of the stuff that you'd want to gather, some of the items would be, your current income, your current savings rate, your current assets, your annual expenses, your investment holdings, and any debts. And this gives you, when you start looking at all this, it will give you a good starting place as to where can you make some changes. And it's also important to really start to think and truly envision and understand what you want your retirement to feel like. How do you want your quality of life to be? And be realistic with what sort of medical expenses. Of course, you can't predict that, but just being realistic with, budgeting and figuring out how much you're going to need to spend every year to maintain the quality of life that you want. So that's really important to do at this stage.
One more important point, I think it's something that's maybe not discussed all that often, but really needs to be considered and reviewed, is within investment holdings, something we call asset allocation. So simply put, that really means it's where you place your investments and in what type of an account, right? This can make a difference in your after-tax return over a long period of time. So what does that mean? So one, investments are subject to different kind of tax rules depending upon their source of return. And then two is the account type may have different tax treatment. So it's either a taxable account, a tax deferred account, or a tax exempt account. A full accounting as to what types of accounts you have, what types of assets you have, because there are strategies that could help you maximize after-tax return if they're placed in the proper buckets. Not necessarily for this discussion today, a further or a follow-on, but just an important distinction on that.
And an example of this would be, let's say you have a 401k and an IRA, and you're age 65, and you want to maximize your Social Security benefit, and you have this period from between 65 and 70. And if let's say you do retire at 65, and you know that you can live on your 401k and IRA to maintain your lifestyle until age 70, you should maximize that income at that point without Social Security. And then at 70, you could then start taking Social Security, and that would be at the maximum, level you could possibly get. And if you, have a family history of long life, longevity, then that Social Security benefit could be worth even more. So you can take the money out of the 401k or the IRA and then just wait and then take the Social Security or use other sources of income. It's a discussion to have with your accountant or your advisor, because you can really maximize your returns if you take the money from the right bucket, whether it's taxable account, IRA, 401k, or including Social Security. These are discussions you should have with your accountant or advisor, because it can make a big difference over the long run. So yes. That's a good point, Scott, because people don't think about the location of their assets and whether to take it from one or the other. They need to think that through.
Yeah, getting the location right is basically a free way to ensure that you are at least optimizing your after-tax returns. It can do no harm. So once you have all this information, you might get a little confusing, but it's time to map out next steps. And really, once you have this information, maybe you'll notice that there's some high interest debt you have that needs to be knocked out first before you even start your catch-up plan. Or maybe you'll see, when you look through all of your expenses, you'll see some pretty unnecessary expenses like some subscriptions that you never use anymore. So there's definitely some low-hanging fruit that's always available, which can basically is a really easy way to boost your retirement savings.
I'm going to interject here something.
Yeah.
Say when you subscribe to some free trial of a subscription or a magazine, there's always this auto renewal function that just hits your credit card month after month after month or year after year after year. It's almost worth it to spend an hour just going through all these expenses you've turned out to be useless. And that's just sort of a pet peeve of mine. But you can save quite a bit if you knock out all those things.
Yeah, it's surprising when you go through that exercise and you add up some of the, because you may have a bunch of subscriptions that are very low, that are low cost. You're like, oh, it's just $10 a month. But when you go start adding them up, and you're like, oh, okay, wow, that's actually, if you have 10 of those subscriptions, it's $100 a month. So it definitely adds up. So when you get to this point, this is really where you have the ingredients to start designing a plan for yourself. And this will definitely be where an advisor can definitely help take the burden off, trying to figure it all out for yourself. An experienced advisor can certainly help with that. Because, we can create detailed projections. We can look at all of your assets. We can really show you where you want to go and help you determine where you want to be and all that kind of good stuff.
But they just one point, just to kind of wrap it up into a nice wrapper of simplicity. Think of your financial journey in kind of three phases, right? So phase one is a period where you have higher spending, but higher earning earlier in life. So your working years. And then the second period would be the period of modest spending. So after the higher spend phase, think about when you enter retirement and you're kind of gliding through retirement. And then the last phase is usually, witnesses a period of increased or elevated spending, which is more near death, right? Or end of life, we should say. And that's due to higher medical and long-term care expenses. So I guess the proper plan can guide you through to understand what the required accommodation needs to be for those spending rates throughout each of the phases.
That's a good point. And typically, according to studies that I've seen, spending in retirement is near the spending you do before you retire in the first year or two. But after that, spending begins to decline as you ultimately, lower your expenses, maybe travel less, maybe do less activities. So spending actually starts to go down after a year or two into retirement on average. This doesn't apply to everybody, but that's something to consider and talk to your accountant or advisor about what your actual spending might look like in retirement.
Yes, for sure. And that's why I think having an advisor, and I'm not just talking about us, any well-rounded advisor who's really got your best interest at heart. They'll be your partner in determining each year in, year out, how you're doing, how is your expenses, making sure that your asset allocation is correct, making sure that you're in line and you're okay, and that you're going to be hitting your goals, and that you're going to be not running out of money, which is ultimately what everyone in retirement wants. Or if you're someone who wants to maintain and preserve wealth to pass on to new generations, it can be really valuable. So the bottom line is, so today we covered the tax advantages of the IRS catch-up provision, the HSAs, some of the information you would need to evaluate your current situation and, try to map out your catch-up plan a little bit. And so, like I said before, an advisor like us or someone else, even if you're underfunded for retirement, that's what we love to do, is help formulate plans to get you where you want to be. So
it's not impossible that you might be overfunded, and that might be good to know.
There's nothing wrong with being overfunded either.
So I see we're at the questions phase. I guess we got a couple of questions that came in.
Yeah, I'm seeing a couple.
Yeah, let me just read what came in. The first one is, can you contribute to an IRA if you contribute to a 401k? Then the answer to that is yes. You can do both. Next question I see here is, can you increase your contributions to your IRA as well as your 401k? Davey, what is the answer to that one?
So yes, for an IRA, age 50 or older, you can contribute an additional $1,000.
And what's the standard contribution on that?
6,000.
Okay. Here's another question. Somebody wants to know, if they haven't maxed out their 401k contribution, can they, for instance, take 100% of their paycheck and put that into their 401k at the end of the year? And yes, you can do that.
So-
as long as you don't go over, you just can't go over your.
Yeah. So at the end of the year, if you look at what you've contributed so far, and if you need to contribute an additional, $8,000, let's say, before the end of the year end, you can take as much of your paycheck as you want and contribute it.
Then the last question was, and I think we covered it already, do you have suggestions about when to take Social Security if you also have a 401k and IRA? And we did talk about that. And if you can fund your retirement from those two sources, then it might make sense to delay taking Social Security and wait for the maximum monthly benefit. So that's perfectly okay.
Yeah, and as always, there's always unique individual circumstances that that should be addressed as well, which is why it's very important to really think through it and talk to someone if you think that's best. And so I guess that wraps it. I'm not seeing any more questions, so that's it. For those that attended, we really appreciate it. We're going to send just a follow-up email with the replay of this, and as well as a link if you did wish to have any discussion with us. We'd be happy to do that. So there'll be a link if you wish to schedule a meeting. But other than that, I do hope you found value out of this. And we look forward to continuing to do webinars and helping educate and help people plan for their retirements.
And also, let me just say one more thing, that if you received this and found benefit from it, and you know of somebody else who would like to hear us or watch this, just forward the link and they can hear the recording, right?
Absolutely. Yep. This recording, it'll be put on our YouTube channel. So for sure. And we'll also post it as a blog post on our website. So yeah, we look forward to hopefully seeing some of you again on future webinars.
All right.
Thank you.
All right. Have a good night, everybody.
Everybody have a good night.